Hey, this is Noble. Welcome to Insider Trading. Let's get started. I'm going to dive right in today. I got a lot to cover. I want to be efficient with my time. So, going straight in. First thing, we need to talk about presidential impact. I want to go back. I'm 44. I know I don't look it. Thank you. I want to go back to 1980, the year I was born. We're going to start from 80 and come all the way forward. We're going to analyze and look at every single president we've had. And we're going to take a look at the data and find out how much during those 4 years, how much did the stock market go up or down from November to November, from election cycle to election cycle, that specific month, right? I think you'll be able to make some pretty interesting insights from just doing that process with me. And these are the types of things you should be doing at home versus, don't get me wrong, it's great to read articles and hear people on TV pontificate about what they believe is going to happen. It's another thing to just pull up the data and look at what's happened in the past. You can get a lot from that, right? So I want you to always do that. Second thing, I want to talk about the perfect indicator. And I know perfect is a big word. There's tons of indicators, but I fundamentally believe there's a perfect indicator that was made to it wasn't even made for the market. It actually just matches up with what trading truly is. So we'll talk about that. And then last thing I want to do, last few weeks, I've been getting a lot of questions, seeing a lot of people talking about the VIX and S&P and how's the correlation? What is the VIX? Does it actually predict anything? Can it work sometimes? Somebody told me 2 days ago, I had a consult with a client of mine. She told me the VIX used to work for me. And I said, oh, the VIX still works. So I had to help her to get some clarity, and I want to give you some clarity as well. So for those of you that don't know me, my name is Noble Woods. I've been teaching kids and adults, training kids and adults to be better investors, smart investors, new investors, as well as traders, futures, options. I love foreign exchange. I don't really touch. I used to. Crypto. I'm not really a crypto guy, but I've developed a really powerful method for trading that I believe has the potential to literally change the world. It's probably the most statistically grounded and sound methodology ever created. I know that's a big claim, but as we'll see today, I can back it up. So let's have some fun. So let's do this. We're going to go back. I'm actually on a quarterly chart. I'm on a quarterly chart. Now, what I did was I already did a little bit of pre-work. So everywhere there's a line, you're going to, it's November, right? It's that election month. You know, presidents don't get inaugurated until the following January. So I'm just kind of going from November to November every 4 years, right? From 1980 all the way until now. So when Reagan took over, as you can see, market kind of dipped for a little bit. The blue boxes are ranges, and I really want you guys to pay attention to these ranges. So imagine this is 1981. Reagan takes over from Jimmy Carter. And for the first 3 quarters, the market really doesn't go anywhere, as you can see on the chart. The first 3 quarters. I know we have these ideas that every time somebody gets elected, the market is going to take off or the market is going to crash. Sometimes we don't go anywhere for years. All right. Again, I'm looking at the quarterly chart. I know you guys don't look at it often. Many of you are always on the day chart, which is okay, but it's limited. It's really fast, right? So when we start doing this type of analysis, you want to adjust your time frame, right? Quarterly chart, month maybe to get some precision. You really want to zoom out annual chart. All right. So from November to November for those first 4 years for Reagan, how much did the market from November to November increase or decrease? 30%. 30%. Had a strong little, as you can see right here, had the classic trend line break. All right, we bottomed out down here, tested this bottom 2 times, finally pushed higher. And then in what is this? Second quarter of 1983. For 1, 2, 3, 4, 1 year and a half, we just ranged inside of this quarterly bar. Right. So yes, If you're a day trader, you've experienced ranges. Market will get stuck and won't go anywhere for 20, 30 minutes. You hate it because you're waiting on volatility. You want the market to move to make you some money, or just so you can lose and know you've lost, right? A lot of us don't have the patience that it really requires to trade and to trade well. But you'll actually also have to exhibit that same patience sometimes on these longer term charts as well. All right. So imagine you're buying leaps, which are longer term options, and basically an options contract that's a year or longer. Long term equity anticipation securities is what they're called. They're just long term, right? A year or more options contract. Imagine buying a year out, 2 years out, but you don't realize we're in a range. You'll lose for the same reason that day traders who don't realize we're in a range lose, right? You're not looking at the data the right way. So that's the first 4 years. That's Reagan. Reagan's next term, his second term, 70%. And at one point, if I put this at the high, at one point, the market from November to November was up 100%. All right. This is, what is that? Third quarter of 1987. I was 7 years old. That's crazy. All right. So 70%, his second term. First Reagan term, market up 30%. Second term, 70%. George Bush Sr., right? And check this out. I didn't draw this one out, but I will just because I'm here. Look at this huge, huge, huge. What is that? Like, look at that. Third quarter, 1988. This bar we stayed inside of for 1, 2, 3, 4, 5, 6, 7. It took 2 years to get out of this rangy bar. And then even once we got out of that ranging bar, we pretty much just bounced a little bit above it for another 1, 2, 3, 4, push back in 5, 6, 7, almost 2 years from that point. So these ranges happen, which is why I'm showing you guys these huge, huge, really long ranges on a quarterly chart. Because if you're buying options contracts, or if you're even investing month to month, and you don't realize that the S&P is stuck inside of a quarterly bar, not going anywhere, hasn't gone anywhere for the last 2, 3, 4 bars, years, that's a problem. It's so easy to see. It takes 2 seconds to see this stuff if you spend the time and get off of just the day charts, right? You need to look at more than day charts. So that was George Bush Sr. I'm actually going to take this blue box off for a second because I don't want to have too many blue boxes. Clinton. Now, this one's interesting because, as you can see, Clinton inherited, maybe some people believe, his policies, because that's part of the question, right? Which party gets us as investors the biggest returns? I think you'll be able to at least going back over these last 44 years, you'll be able to put some analysis to that question and answer it yourself by the time I'm finished. All right. But Clinton, 70%, as you can see. We took off. Now, this is this is leading up to what, 96, 97? Going into .com bubble, starting to swell. What does that mean? Just any and every company with .com, .net, the Yahoos, the Amazons of the world, all of those companies were just making anything that IPO late 90s, people were just buying it out of a frenzy of trying to make money and not miss the boat. Same thing that happened was with crypto and everything else. There's all kind of bubbles that happen, but this is like one of the biggest, most widely known bubbles, right? But what you got to realize too is before that, 1, 2, 3, 4, about 2 years. So Clinton's first 2 years, the market really didn't go anywhere. Stuck inside of a range. Once we got outside of the range, investors like me would have saw that, would have paid attention. If there's volatility, which is the only reason we come out of those ranges anyway, you know it's time to buy. The market is going higher. You just don't want to miss the boat. All right, so that's Clinton's first term. Second term, it just continued on all the way up to 2000 where we made those highs. So that's a 90% return. Clinton's second term. Oh, and I'm looking at the SPX, which is S&P 500 index. It's really 502. Biggest, best stocks, broad market index that just basically helps you to know, is my favorite stock up or down? 80% of stocks in our economy are correlated to move with the S&P. All right, so if the S&P is up for the day, your favorite stock probably is as well. All right. when I teach it to my kids, or used to, I call the S&P, it's like an all-star team. It's just the biggest, best players. You don't want to bet on LeBron or Bronny. You don't know who's going to be a standout star this year. Just bet on the all-star team. It's all the best players anyway. All right. You get to cheat a little bit. Okay. That's Clinton. Bush. W inherited. I don't even say he inherited. When he took office, the market started to pull back. This is 03, the bubble bursting. Tough. Bubbles bursting. All these companies that people think are going to amount to something and be worth something in the future, we're realizing they're really trash. Just a lot of trash. It's almost like NFTs, right? Remember, like a couple years ago, everybody was trying to buy and sell NFTs. Now nobody talks about them. It's just hype. It's hype, it's speculation. We just, as human beings, we create and innovate and just make stuff. And then we start telling people it's going to be worth something in the future. And because people are greedy and don't want to miss out, but don't do their research and aren't patient, and maybe you could argue you shouldn't be patient to miss out on an opportunity. But if that thing is going to be around, it's going to be around either way. Right? So NFTs, bubbles bursting, it happens. Again, Bush first year, George W., down 20%. Now, this is interesting. I almost need to show you both. I need to show you both terms with George Bush. We made those highs, 2000. We came pull down here, came all the way down to about 800 on the S&P. Went back up to it, its highest on his second term, right back up to the same place. That blue line is called a support price. Resistance. Just means it's a ceiling. Prices having trouble going higher. Market is not going higher. Investors don't believe in it. We don't find value in the long term. Something's telling us there's a reason we shouldn't be buying. So we'll go up, test those exact same prices, and turn around. As you can see, recession 08, subprime mortgage crisis. You were there. I was there. We all lived through it. The question is, did you know what to do? Have you been a continuous solid investor month after month, year after year since then? All right. Came back down roughly to the same exact low. Same place. Support. A lot of you guys are supporting resistance traders. This is all it means. You're just going back looking, where's the last major high, last major low? Expecting us to go there, people to see those prices, and then the bulls, right, the people who are optimistic are going to say, hey, we're back at 800. This is a great place to buy because it was the lowest we went last time. All right, and then groupthink happens. We all start thinking the same thing. We do the same thing. Market pushes back up because of all that volume that's being bought down at the bottom. All right. Obama, President Obama's first term, inherited, if you will, or maybe it was his policies. Maybe it doesn't matter. I don't know. By the end, again, you tell me. Either way, he took office right when we were at the bottom of the market. All right, 09, that January, that first quarter was the low. And over his first term, 45%, basically right back up. Let me kind of stretch it out. Right back up to those, that 1,500 level of resistance. Finally got above it. Obama's next term, market is up 50%. I'll just keep going. Trump, after Obama, 60%. This really big, ugly red bar is COVID. I'm going to break down a little bit more on this chart as well because I do want you to see a few things that I haven't even touched on. And then where we are right now, this is Biden. Another big, long range, right? Was that second quarter of 2022, right? This big red bar right here, I'll zoom in on it. And it took 1, 2, 3, 4, 1, 2, 3. It took 7 quarters. All right. So we made that drop, stayed inside of it, 7 quarters, finally, before we got back to the highs. And as you can see now, at the time of watching this, what is today's date? It's July 29th, 2024. Just made new highs this quarter. All right. So that's the last 44 years. Biden, Democrat, 60%. And think about it like this. I know nobody buys Nobody invests this way. Maybe some people do. I don't know. Maybe I just created a concept, right? Invest in November when a new president takes over. Put that 10,000, 100,000, 500 bucks, whatever it is. Put that money in there and just relax for 4 years till the next election. If we were to do that, Biden, Democrat, 60%. Trump, Republican, 60%. Obama, I'm going backwards now. Obama, Democrat, 50%. Obama, 45%. George W., second term, -15. First term, -20. I think the Democrats are winning if it actually matters, and this isn't just the market does what it does, and presidents are just, get to manage the economy over it. Clinton, second term, 90%. Clinton, first term, 70%. Bush, senior, 50%. Reagan, second term, 70%. Reagan, first term, 30%. 30%. So, does it matter which party controls the White House? Is that what dictates and determines? Do their policies really drive the market? If you were a Republican and you lightened up on the Democratic years, would you look back now thinking that was wise? No. Hell no. You wouldn't. Those Obama and Clinton years were, all right, undeniably. It's just data. It's not about, all right, this is a bipartisan type of show. I'm not saying you should be a Republican or Democrat. That's your choice. All right. Pray about it. Do your research. Use some emotion. Use some historical context. Get to know the parties. Get to know the candidates. Do all of that stuff. But when we start talking about the market, you need some charts. You need some information. You need data-driven decisions. And as you can tell, there's really no bad time to be an investor over the last 44 years. Even if you think about George Bush's 2 terms, those were just amazing times actually to continue buying. Why? Because if we look back, and let me take everything. Actually, no, let me save this first. Let me save this real quick. Presidents. Okay, and then let me get rid of that really quick to make my point clearly. I want to take everything off. Now what you see is pretty profound. It's pretty profound. This was the recession. And so what happened after the recession, 2009, 2010? We've basically had 14, almost 15 years of nothing but buying and buying and buying and buying and buying and buying. All right, it's been an amazing, amazing time. Okay, had to send a quick text so I could stop getting those text messages. Okay, so we've touched on a lot of information. Really quick, easy to do. If you have Thinkorswim or any platform, you should be able to do that type of analysis yourself. All I did was draw the lines. I figured out November to November. All right, you go back, you want to match it up with the presidents, and then you just want to do some basic analysis. How much did we go up or down, right? So my first note is checked off, presidential impact. Hopefully you can see and you realize now that you need to keep investing. It doesn't really matter which party's in control. And if you slacked off because your party was not in control, all you did was lose out on making more money, building wealth for your family. All right. Hopefully I've proven that to you today based on the last 44 years. Okay. Perfect indicator. This isn't tricky. This is simple. This is simple. I'll show you, but actually let me come back for a second. So think about this. What moves the market? What moves the market? If you're an investor or trader, you have to actually understand what moves the market. I tell people all the time, trading is not what you think it is. Most people come to me as a coach, as somebody who teaches, has classes, seminars, has been doing this for over 10 years. People come to me and say, hey, like, I want to learn how to do this. And what I think they're actually thinking is they have these dreams of like sitting in their pajamas and trading and making a couple $1,000s every day and living this amazing lifestyle, and you can travel, you can like you're free. People always want to tell me about freedom. And I'm like, but what is trading though? How do you know you want to do something that you've never done? I know it can make money. Yes, this is like the engine for wealth and riches, true. That's the easy part though. What actually is trading? It's data analysis. Every chart is nothing but numbers visually shown in a pretty picture so we can, right, make something from it. Apply technical indicators, math, statistics, right, forecast prices to go with the trend and make money when that stock is going up. That's it. So what's the perfect indicator? I got to go back to my first question. Well, okay, so now that we know that trading, investing it actually is data analysis. That's what the job is. Then how do markets move? Why do they move? Why does Apple go up? What do you need for prices to move? You need volatility. And what is volatility? The technical definition, which you should know, it's a statistical measure of price dispersion. A statistical measure. Uh-oh. So we're already at point one, which is, do you know anything about statistics? Did you realize that this was statistics? Volatility literally is measuring. That's all it is. It's measuring, right? It's a statistical measure of price dispersion. What is price dispersion? Just think about it in simple terms. It's almost like, let's say you have a class. Let's think about grade dispersion to make the metaphor. If all the students in the class are averaging 75, right in the middle, the average is 75. You know that there's some people are going to get lower than 75. You're going to have some 45, some 30s, some Fs. But you're also going to have some students who average higher than the average. So you're going to have some high Bs. You're going to have some As as well. Right? So that's dispersion. It's just where those grades fall on a scale. So where do prices fall? Every year, every quarter, right, we get different closing prices for every candle. The problem is people don't understand that you really need to know and kind of have some clarity around what's the average, and are we under the average or above the average? All right. So the only way to finally now give you this indicator, the only way to figure out, to actually assess exactly what the definition of volatility is, to make that perfect connection back, you need something under statistics that you will take in a statistics class I've taken two in my lifetime. Indiana University undergrad, Clark Atlanta, getting my MBA. I love stats. The one thing that actually gives you a statistical measure of price dispersion is standard deviation. Standard deviation. There's a formula. It's easy to well, you probably not gonna memorize it or pull it up and actually learn what it means fully. But anybody who does any sort of statistical measuring of data, trying to predict, forecast anything, you got to understand standard deviation. So let me pull it up. The only indicator that actually shows the average and then gives you standard deviation so you can actually see different levels of volatility and see when we're bullish or bearish based on math. Based on the math, right? You got people out here talking about, trying to make it seem like trading and investing is magic. It ain't magic, it's math. I say it all the time, it's math. So Bollinger Bands, it's one of the first indicators I use because I actually understand and love stats. It took me years to get here. A lot of questions, a lot of thinking. I could literally do an 8-hour session right now if I had enough people, just breaking down Bollinger Bands and how to use standard deviations. There's some amazing things you can do with standard deviation. But today I just want to give you the red line on my chart. The red line on my chart is essentially a one period. I mean, not a one period. It's the 1.0 positive standard deviation. It's almost like the average away from the average. The bottom band, this red line on the bottom is a -1. So we just got plus, all right, plus and minus -1. The yellow line in the middle is just the average. So I'm staying on these quarterly charts. And I'm want to go back for a second. I want to go back to presidents. I want to put all of that back on my chart. And then what I actually want to do is I'm going to take the names off for a second. And if I go all the way back, what you'll notice is that Reagan's first term, all price did was it came back down to test the average. This, my friends, is a statistical concept. It happens all the time with everything. Oh, y'all can't see the chart. My bad. There you go. Right here. So again, the top red line, all uptrends will be above that red line. It's one standard deviation. It's math. All downtrends will fundamentally happen underneath that bottom band on every asset you can talk about for the rest of our lives and on every time frame. Super powerful. I call it the one. One, because it is that indicator that you really need. You really don't need much more than this. But it's also it's probably one of my favorite indicators because I use it and know it really well. So we pull back to the 20. Why is that important? Because it's something called regression to the mean. What is regression to the mean? It just means price will always pull back to the mean. Nothing goes up forever. Right? If you have a great day, nobody stays positive forever. You're just going to have some normal days where you just chill. All right. If you're under that bottom band, think about it. If you're sick, you're depressed, you're having a bad time, life just is not treating you well. You're not going to be down forever. All right. You hit that zero, right? You know what that means. I won't even say the word. But we go through bad times and then we come back up to what? Our average. And then before we can get to the good times, before we can really get our mental health back, right, self-care, all that stuff is what everybody's talking about right now. But before you can get there, you got to get back to your average. All right. And so you can literally see this with pricing. You can see it perfectly with pricing. So what happened during this second term? Above the top band, above the one. That's where anytime prices actually going higher, making higher highs, we're always going to be above this one band. Right in here, what happened? We tested the 20, pushed down, one bad quarter, slowly got back up. Right. So you're looking at volatility. Above the one is where all the strongest, most important, it's where the precision for what I teach comes in. All right, look at this. Bounced off the 20 again. Up, 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 up. These are Clinton's terms. This is this long 2-year range. Still above the one, still positive, still bullish, still strong and volatile and bullish because we're above the one. How do I know? Because we're above the one. All right, look at that. Clinton's entire 2 terms was just higher, 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 higher. Small pullback right here, touched the band. Went right back up, higher, 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 higher. This is the pattern you need to know. Forget about, and don't get me wrong, supply and demand, support and resistance, all of that really basic stuff is cool. You can learn all the chart patterns and ascending triangles and all that stuff. That's great. Whoop-de-doo. But if you don't know this, you're not fully tapping into what the market actually is. Again, what is volatility? A statistical measure of price dispersion, which you can only actually see with standard deviations. And the best tool to see standard deviations, to literally put them right on your chart where you can see where it's time to buy, is Bollinger Bands. People use them wrong, though. Most people use the 2.0, and you shouldn't use the 2. You want to use the 2 if you're counter trending. You want to short at the high, and you really don't want to do that often. Because these trends, as you can see, we can just trend for like years. Right. Right in here, whenever price comes back inside the bands, 68% of prices will be inside the bands. Back inside. Whenever we get back inside, that's where you need to start thinking about reversals. So we reversed down into a downtrend, .com bubble bursting, and then we reversed back up. All right. And then we came right back inside the bands. Now this is a not .com, but a subprime mortgage crisis, 08. Right. And then it took a while, but we got back above the bands. And then what happened? We took off higher, 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 higher. Even after this 2-year range, which should not have made you go crazy. Why? Because we're still above the bands. We're still above the 1, which is just strong volatility. Statistically strong volatility, where all the uptrends happen. I had a little push down right here. This was COVID. COVID tested the 20, popped right back up, rejected right back out of it. Just a lot of fear. Everybody was scared. We never experienced a global pandemic. That's all it was. Came right back up. Tested the 20 at the lows of 2002 again. Ranged for about a couple years. We're right back now above. We're back at that place where the volatility, this is where the volatility is so strong. It's where it creates all the trends. That's it. The perfect indicator, Bollinger Bands, because they use standard deviation, and because standard deviation is the one tool, again, that perfectly matches up with what is volatility. And if you don't have any volatility, this is all you're going to get all day. Price will be flat. You won't be able to make any money to the upside or downside if we don't have any volatility, if nobody's buying, if there's no volume. All right. Okay. So that was rich. That took me years to learn. This is kind of like the core fundamental philosophy and statistical grounding that comes with the Noble Woods method. I know I haven't really said anything about it, but this is like what I teach my students. It took me 15 years to get here. I think it's actually the way that every business school in the world should teach investing and trading. It can be taught. It really can. It's not this weird snake oil magic thing where you got to have some insight and be able to predict. All the gurus and people that try to like sell you on how well they can predict things, stay away from those people. Again, this is not magic. There's no crystal ball. It's math. Standard deviation and statistics is not new, and I damn sure did not invent it. Luckily, getting my MBA at Clark Atlanta, working at Bank of America for a few years in corporate, I just had a lot of roles that made me analyze data. All right, so I leaned towards Bollinger Bands from day one, and then over years, all right, years of losing, years of struggle, I just really started to think it through, and I figured out how to use them correctly. Best indicator that I can give you. The funny thing is at the bottom, you probably see on the bottom of my chart, there's a TTM trend. So that's one of John Carter studied, trade the market, TTM trend, trade the market studies. TTM squeeze. The squeeze is actually using Bollinger Bands too. It's what's giving you sort of, the top of my chart is like the price trends and what price is doing. The bottom is really showing you volatility. That's a whole nother video though. Whole nother video that I don't have time to do right at this minute. So let me go back to my list. So S&P 500 and the VIX. So, okay. I got to show you the VIX. The VIX is the Volatility Index. Some of you guys know this, some of you guys don't. So the VIX is the Volatility Index. All right. And all I want to show you is this. If we look back, this blue line at the top, it's a 200 period simple moving average on the weekly chart. What the VIX does, they call it the fear index. Whenever the VIX is going higher, it's only because people are afraid. There's some unknown factors. When COVID happened, the VIX spiked really high for that quarter, that month, right? March 2020. Why? Because nobody knew what the heck a global pandemic actually meant for our investments, for our lives, for our jobs. Nobody knew. Quarantines? I got to be quarantined? Wait a minute. Like some apocalyptic movie stuff? All right, yes, that scared people. So what happens is folks who own shares, which you should own, but really wealthy companies, countries, people, families, right? When some really tricky things happen and you know the market can potentially come down, it may potentially get bad. What do? You use options, you buy puts just as insurance. So even if the market drops 30, 40, something crazy %, you still should be making money to the downside without sacrificing having to exit your actual shares, right? Your investments. That's why you use options, or how you can use options. All right, 90% of people use options to make money, but that other 10%, 10% of the world is using options to protect their wealth. Right? So, again, the other last thing I need to say is the VIX measures or connects to the S&P directly. So it's specifically connected to the S&P. Not NASDAQ, not the Dow, not right, none of that other stuff. It's connected specifically to the S&P 500. So when the VIX spikes, that means the S&P is dropping. Why? Because we're selling because we don't know what's happening, which is why they call it a fear gauge. So with that, it's like the baseline. I know that was quick, but hopefully that made sense. If not, just go back and watch this again. We touched this 200 period moving average. Let me pull it up and show you one more time. This was the week of April 15th. April 15th. So already knowing that prices pushed up, right? Couple weeks earlier, we were down at 12. We pushed from 12 up to 21. That's low volatility, easy flowing market to volatile, but also because it went higher, that means the market came down. Can we verify that really quick? Yeah. We'll just hop over to the SPX and I'll look at the exact same time frame. All right, if I go right here, this bar, 415, which was April 15th, the exact same week when the VIX spiked up to test its 200 period moving average on the week chart. S&P came down. Where did it go? It just went to the 20. That's all it did. Week chart just came down to the 20. Predictable. No, I won't even say predictable. Easy to forecast that. Right. I want you to start thinking like a trader, a quant. It's like a quant guy or girl. You can forecast what's going to happen based on what's happened, based on understanding the math and how these indicators and tools work. All right. We're here now. There's a 220 again, not too far away from where we are right now today. And if I go back to the VIX recently has been pushing higher. Now it almost hit the 20. Almost hit the 20. I mean, it almost hit its 200. Which explains why the S&P over the last few weeks has been coming down and why last week was a bearish week. So this is what you know. Price is above this band, which means if we get one more spike where we get up to 20 again or 21, I can tell you now already what's going to happen. Price on the S&P is simply going to come down and do what? Test the 20. It's going to test the 20. That's all it's going to do. That's what it did last time. All right. And then check out what happened after we were able to get back above the 1. Slowly pushed higher. New highs, new highs, new highs, new highs, new highs, new highs. Right. This is where you get precision with your trades. You don't want to be in trades just sitting, waiting and hoping and praying that this stuff moves. You don't. I know you don't, because I don't. And even if we're talking leaps or investing, do you really want to be in a stock that is underneath this 1.0 negative 1 band that you may have to wait years for it to actually start making you money? Like, people get excited about buying at the low. It's ego, it's cocky, it's not logical. I don't think it makes any sense. And I used to be that guy, just like you. Right? Everybody wants to buy at the low and have all these amazing stories. I could care less about buying at the low now, years later. Because when we're at a high, we're only at a high because we're getting strong volatility. All right. So if you could back up and kind of understand how this really works and see it before it happens, as you forecast the trends, knowing how the math works, you really can get in front of every trend on every single asset that moves. And on every time frame. Year, quarterly, month, 5 minute, 1 minute. 1 minute is crazy, but I love the 1 minute. 30 minute is really like my go-to on day trading. 30 minute I love. So I'll do one last thing here. One last thing, because I just want to show you this too. So I'm going to zoom in just a little bit more. I'll zoom in just a little bit more for a second. This is the day chart. I'm flipping back and forth between time frames. That's advanced, but it's the same core principles. Time frame doesn't matter, right? It took me years to get this, but now I can be on the day and tell you what's going to happen on the week, or be on the week and already know what the day looks like, right? These are just overlaying patterns, but there's really only one true story happening, right? So check this out. Right here on 7/15, right here, 7/15. Which is July 15th. The VIX came out of this long, ugly range and finally closed. That was the first bar where first day where we closed above the one. That's telling you I'm getting stronger. I'm getting stronger. I'm about to go up. VIX is about to go up, which means S&P is about to come down. Right, 717. We fully got above both bands. We made a high. We pushed up. We pulled back. I love this little trade right here because we're above the one. The volatility on the squeeze is increasing. It's the perfect time to buy because you have strong volatility and you got a small pullback during a strong period of volatility. All right, so remember that day, 717 and 723. Both of those were great days to know that if we broke the high of both of those, right, if we broke the high here and if we broke the high here, we're only going to go higher. Strong statistical chance of going higher because we're in that volatile move. So last thing, if I just go back, 717 to 723, I'm going to go back to SPX. So this is 717. Right when we started to creep back inside the Bollinger Bands, where are we going? Right down to the 20 like we always do. If it's a strong downtrend, to the bottom band. 2-3 days right here, we push back up. Ooh, hammer-ish type candles, long wick. Bulls pushed up during that day, closed bearish, right? The squeeze volatility is decreasing. It's getting lower. We're coming right back down. These are like picture perfect trades if you just understand that this is data analysis. You need a little bit of stats. And these Bollinger Bands, this one standard deviation is like amazing. It's so amazing, right? So we gap down. People hate gaps, but if you knew that this was like a trigger, and for me, with my system, what I teach, these two blue boxes, you'll always know. Well, I use blue boxes in a couple different ways, but these two are triggers to let you know if we break the low of that day, just go with it. You're getting in as the volatility is dropping, trend direction is going your way, and volatility is going your way. All right, a lot of people think it's about catching the trend direction on price. Price is tricky, right? Volatility is what manufactures price. So you can have a lot of people buying, but if there's not enough volatility, a trend's not going to develop, right? So you should actually trust and learn more about volatility more so than just cute little pricing patterns and all these weird names for all the different technical charting patterns. Again, I've been there. I've done all that type of research. I know all the patterns. I used to memorize the names. I got all the books over here in my library that you have. I've done all of that literally for over a decade. I'm with you. But this is what undergirds the market. It's volatility. If we don't have volatility, if you don't understand a baseline of statistics, you're making trading really, really, really tough. Really tough. And I just like to help give people clarity. So. If this resonated, if this is helpful, I want you to, one, subscribe to my channel. Please keep watching. Over the next year, 2 years, I probably have already about 200 thumbnails for YouTube videos and ideas already ready. Like, I'm prepared. Took me a long time to get here. Right. I hadn't been building my channel. I said, let me slow it down. Let me figure out how to do this the right way to produce high quality content fast, right? In a way that will sustain my audience and give you guys what you need. So 1, watch the channel. 2, go to my website, limitlessclass.com. Give me your email address. Just pop it in. I don't send a lot of stuff. If I do, it's going to be valuable. You'll get free trainings. You'll get free workshops. Sometimes I do free consults with people. I'm here to change the world. I really am. And this Noble Woods method, because it's based on statistics, and this is like, oh my God, this is like 1% of what I could actually teach. But as you can see, it works, man. It works. And you need more than technical analysis. I feel like this is the evolution of technical analysis and patterns. Everybody and their mama knows patterns. Why are the patterns happening? You have to be able to look at something deeper. Right, you have to. You really have to. So hopefully this was helpful. Last thing I'll say real quick is I actually have 2 upcoming classes that if you're ready to increase your level of commitment, you would be crazy not to consider signing up and talking to your wife, your husband, whoever. I have some payment options. You don't have to like pay it all at one time. It's premium for sure because this is the best methodology you will find in the country. I don't care who they are. I don't care who you learn from. If they don't start talking stats, they don't really get what this is. They really don't. It's data analysis. It is. That's why statistical measure is literally in the definition of volatility, which moves the market. All right, so September of this year, 2024, I'll have my live 4-week options class. Ooh, it's gonna be amazing. It's a lot of content, but I figured out if you can if you can sacrifice 1 month of focus, of dedication to raise your commitment level to learn this for yourself and your family, I'll do my part. It'll be literally a 1 month that changes your life fundamentally. It will expand your financial options, your potential financially in the market. It'll make you a better investor, swing trader, day trader. It's all the same to me. I don't really care about the time frame. I'm going to do the same thing. I'm going to think the same thing. I'll have the same exact entry on a 1-minute chart that I would have on a quarterly chart if I was buying leaps 2 years out. Exact same recipe. All right. So that's September, and then October will be futures. I started with futures. I learned futures. That's really my base, but I think options will give you more options because you can do more with options. Futures is mostly day trading, but some of you guys just have that really. You're more of a day trader. You want to make fast money. You'll go through the work. You'll do it. You'll do everything I teach you, tell you that you need to do. You have that type of aggressive personality to make money daily. And you just accept the challenge because it is tough. It's a lot. It's a lot, but you can learn it. So again, subscribe to the channel. If this resonated, keep watching. I guarantee you a year from now, you're going to probably learn more from my channel than you will have learned from some educators and classes that are $5,000, $10,000, because nobody's really teaching from the core of what the market is and really giving you like the visuals and all that nice, fun stuff, but breaking down the why is important. So thanks for watching. Share this video with somebody that you know and that you love. Come back. Please come back. I'm just getting started. Even though this is year 15 for me, I'm just getting started. So thanks for watching. Share this video. Peace.